The Bank of Canada has kept interest rates on hold for a fifth consecutive meeting at 2.25%. Joining us for more is TD senior economist James Marple. And James, what's your reaction to the decision? Any surprises here for you?
Well, precious little changed in the statement. As you said, fifth consecutive hold. Their statement recognized sort of the weakness in economic activity we had early in the year, but also pointed to what we've seen in the job market. Very little job growth, but at least one positive month in the last month. So higher energy prices, raising inflation, still a lot of uncertainty on trade, and economic activity that points to continued economic slack, which is an important measure. When the Bank of Canada says that, it means that they expect that to lower inflation going forward.
Okay, I want to talk about that economic slack because Canada's economy has now shrunk for 2 straight quarters, technical recession. Inflation remains elevated due to higher oil prices. Is it premature to say that we're in a recession?
Yes, it is. I mean, the decline was very, very small, 0.1% annualized, and even if you average over the 2 quarters, it's a very small decline. Typically, we think of a recession as something that is, deep, broad, across the economy. The reality is we have a shrinking population, and that is going to weigh on headline economic growth. You kind of want to look through that and look at per capita terms perhaps, but also just look at the broadness of the decline. And there is some volatility in government spending, in inventories and in imports. So not something that I would say is proof of a recession, but certainly the economy is not doing well, and we have a lot of headwinds: trade policy, higher energy prices, and just geopolitical uncertainty.
Yeah, you talk about those headwinds we are facing from different sides. We've got the Iran war, it's causing higher oil prices. We have U.S. trade uncertainty. So what does this all mean for Bank of Canada policy going forward?
Well, we think the bank will be on hold through the remainder of this year, but that will depend on exactly those scenarios. So for energy, the expectation is that there is a resolution of this conflict in the next month or so that allows the strait to reopen and energy markets to gradually normalize. If that happens, oil prices by the end of the year will be lower. I think there is some risk that if this continues longer than that the physical inventories start to run out and we really see another leg higher in energy prices. And that's the scenario that the Bank of Canada has talked about in terms of what would require them potentially to have to raise interest rates. If we're looking at a situation where oil prices are rising into 2027 when they're expected to be falling, then inflation is more than temporary. It's pushing higher, and by then it's transmitting probably into core inflation, and it's not something that they can ignore. On the other hand, we have the USMCA negotiations. We have the U.S. administration that has continued to add tariffs and continues to point to new issues that it has with Canada. Still a lot of uncertainty there. Could go both ways. We could end up with a deal that lowers some of the 232 sector-specific tariffs on autos and on steel and aluminum. That would be great. But at the same time, we could see that the whole thing blows up and there are higher tariffs going forward. So, that's kind of the balance that they're looking at. I mean, I think we really have to follow the events almost as much as the economic data in trying to guess what they're going to do next.
Yeah, okay. Let's talk a little bit about the Canadian dollar, because it recently hit a 6-month low against the U.S. dollar. What are the factors that are driving that weakness of the Canadian dollar, and where, importantly, do you see the loonie over the next little while?
Sure. Well, it really reflects 2 things. One, we've had this kind of weakness in economic activity, talk about recession. We've also seen, the second thing is inflation has been falling in Canada. I mean, the core rate, the headline is up 2.8%, but core inflation has actually been really well behaved. And that's quite different than what we're seeing in the U.S., where we had another inflation report out today. Inflation's pushing above 4% on the headline, but even the core measure is around the 3%
That's
mark.
well above the Fed's 2%
It's well above
target.
and has been for several years. So expectations for monetary policy in the U.S. have really shifted relative to earlier in the year. Before the oil shock, before the war in Iran, expectations the Fed would be cutting. Now there's expectations for potential hikes later this year. So you're seeing that in a widening spread, especially in the 2-year space, which tends to drive the loonie. And of course, just the geopolitical uncertainty, economic weakness, and the different inflation, I think, explains the weakness in the dollar. Now, again, going forward, if we do see some resolution of this crisis and energy prices start to come down, then I think it's more of a US dollar story, where that's a situation where these expectations for rate hikes start to come off, and I think the US dollar kind of weakens against not even just the Canadian dollar, but a broad basket of currencies. But that should be one in which the Canadian dollar strengthens at least modestly through the end of the year.
All right, and finally, what's notable that you'll be watching over the next little while as the Bank of Canada considers its next move?
Yeah, well, obviously the events, watching just oil, the oil price, and hoping still, like day by day, week by week, for some resolution that allows global energy prices, energy supply to normalize. The trade negotiations and the tariff regime is obviously very important. And then on the economic data, we expect to see a rebound in economic activity in the second quarter. That's been pointed to in some of the higher frequency data, the monthly data for trade and for spending. But watching, obviously the real economic data and confirmation that the economy is bouncing back after this so-called technical recession. Good job report in the last month, but obviously continuing to watch that and the inflation numbers. So all the headline data that they're watching, but I think obviously really dependent on these event risks.